Hello everyone. In last session, we discussed with regard to mutual fund, in that features of mutual fund and constitution of mutual funds in India, right? In this session, we are going to discuss very important concept, that is functions of asset management company and types of mutual fund. That is very important. Types of mutual funds. Okay. Now, what is asset management company? What is management company? What is the duty of asset management company? Asset management company, also known as investment manager, right? Asset management company, also known as investment manager. What is the main function of AMC? The main function of AMC is to manage the affairs of mutual fund. Remember, what is the main aim of asset management company? The main aim or objective of asset management company is to manage the affairs of mutual fund. Is it clear? Okay. Let's see. Functions of, 1 minute. Functions of asset management company. Now, see, AMC, that is Asset Management Company, is responsible for receiving funds from various clients and putting these funds to schemes to get better returns. Now, what is the role or responsibility of AMC? AMC is responsible for receiving funds from various clients. Clients is nothing but here investors or unit holders. Okay, receiving the funds from various small investors and putting these funds to various schemes to get better returns. Schemes in the sense different types of mutual funds. Remember, receiving the funds from various clients or various number of plenty of investors, small investors, and putting these funds to different mutual fund types or schemes to get better returns. That is the responsibility of AMC. Receiving the fund from the investor and using that funds, and that using that funds in the sense, they, after analyzing the different sources, that asset management company is going to invest in different mutual fund types or mutual fund schemes, okay, to get a better return. Is it clear? That is the main function of asset management company. AMCs are responsible for the entire operation of the mutual fund. As I told, AMCs are responsible for the entire operations of mutual fund. The objective starts right from making the financial goal for a fund. See, the another function of asset management company is fixing a objective or a goal for a fund. In the sense, fixing a objective or a goal for a fund. Is it clear? That is the another function of AMC or asset management company. Then it is followed by selecting the asset class, whether debt, equity, or any other financial assets are to be included, followed by the selection of stocks, debt-based bonds, real estates, etc. See, uh, you know what is portfolio construction, right? What is portfolio construction? Portfolio construction is nothing but grouping of securities. See, what is the duty of asset management company? They are going to collect small amount from large number of investors, and on behalf of these small investors, they are going to invest in different sources, right? So first, asset management company is going to decide what are the different sources, right? Then they are going to they make a combination of different sources. That is nothing but portfolio construction. That's what says this particular sentence. Selection of stocks, debt-based bonds, and real estates, etc. That is portfolio construction. Is it clear? Then an AMC would appoint a fund manager for a mutual fund scheme. See, an AMC would appoint a fund manager for a mutual fund scheme. This means that under an AMC, many mutual fund schemes can be present. Okay. This means that under an AMC, many mutual fund schemes can be present. Each and every mutual fund scheme under the AMC will have a fund manager. For every mutual fund, there is one fund manager. This fund manager will micromanage the mutual fund scheme, whereas the AMC will manage all funds at a macro level. So, what is the duty of fund manager? Fund manager duty is to one manage only one type of mutual fund, right? That is nothing but micro in nature. Micromanage the mutual fund, in the sense they are concentrating only on one particular type of mutual fund. That is the duty of fund manager. Then what about the asset management company's duty? Is to manage the all funds at a macro level, all types of mutual fund. That is the duty of asset management company. Is it clear? Next important concept, that is types of mutual fund. Okay, this is important. Types of mutual fund. In that first one, open-ended schemes. What is this open-ended scheme? An open-ended mutual fund is one that is available for subscription and repurchase on a continuous basis. These funds do not have a fixed maturity period. Say, open-ended scheme or open-ended type of mutual fund is nothing but at any time you can purchase, at any time you can sell that particular mutual fund. There is no fixed maturity period. Is it clear? At any time you can purchase, at any time you can purchase, and at any time you can sell. Anytime you can purchase and at any time you can sell. There is no fixed maturity period. Such type of mutual fund is nothing but open-ended fund. Hope you are clear. Second one, closed-ended fund. Okay, what is closed-ended? There is a stipulated maturity period, in the sense there is a fixed maturity period. Take for example, if you buy one particular mutual fund, okay, company A mutual fund, for 3 years, okay, after 3 years only you can sell that particular mutual fund. That is nothing but closed ended, in the sense at any time you can't sell that particular mutual fund. There is a fixed maturity period, then only you can sell that particular mutual fund. Is nothing but closed ended mutual fund. Hope you are clear. Open ended in the sense there is no fixed maturity period. In closed ended there is a fixed maturity period. Open ended, at any time you can purchase, at any time you can sell, but in closed ended, after only a certain period you can sell that particular mutual fund. Is it clear? Okay, third one, growth or equity oriented schemes. The aim of growth funds is to provide capital appreciation over the medium to long term. Such funds have comparatively high risk. Equity funds are, or growth fund, comparatively high risk. These schemes provide different options to the investors, like dividend option, call a capital appreciation, etc. Here, in simple term, what is growth fund? See, the asset management company is going to collect small amount from a large number of investors, right? Then that asset management company is going to invest in different sources. Now, the asset management company, the collected fund is to be invested only in equity shares. Different companies' equity shares. That is nothing but equity oriented scheme or growth oriented scheme. Is it clear? Collected amount is invested only in equity shares of different companies. That is called growth oriented or equity oriented scheme. That is why it is highly risk. They are going to invest only in equity shares. That is why it is highly risky. Okay, next one, income or debt oriented scheme. Now, what is income or debt oriented scheme? Now, the collected amount is to be invested in debt securities. Remember, debt securities, in the sense which gives fixed rate of interest. Debt securities, in the sense those who give fixed rate of return. Your income or debt oriented scheme is nothing but the aim of income fund is to provide regular or steady income to investors. Such schemes generally invest in fixed income securities such as bonds, corporate debentures, government securities, and money market instruments. Such funds are less risky compared to equity schemes. Now, see, the asset management company, the collected amount is going to invest only in debt securities. It may be corporate debentures or government securities or money market instruments. Is it clear? That is nothing but debt oriented scheme. If you invest in debentures or government securities, there you get fixed rate of return, fixed rate of interest. Such type of mutual fund is nothing but debt oriented schemes. This is less risky and as well as less return. Such funds are less risky compared to equity schemes because you get regular return, regular fixed rate of interest, right? Regular fixed rate of interest in if you invest in debt oriented schemes. Next, balanced fund. Now, what is balanced fund? Collected amount is invested in both, that is equity as well as debt funds. Is it clear? It is nothing but mixture of equity fund and debt fund. Balanced fund is nothing but it is a mixture of equity fund and debt fund. In the sense, the asset management company, whatever they collect amount from different small investors, right? That amount is going to invest in both equity as well as in debentures, government securities, right? So it is mixture of equity fund and debt fund. That is nothing but balanced fund. Hope you are clear. Next is money market funds. Now, what is money market funds? Money market funds invest in short-term or maturing within 1 year interest-bearing debt instruments. Now, what is money market instruments? We studied, right? Short-term instruments, right? Short-term debt instruments. Here, the asset management company, the collected amount is going to invest only in money market instruments. Is it clear? That is money market funds. The collected amount is to be invested in money market instruments. That is nothing but money market funds. Is it clear? These securities are highly liquid and provide safety of investment, thus making money market or liquid funds the safest investment option when compared with other mutual fund types. This is safest mutual fund type because this is for short term. Remember, this is for short term. Then, industry specific schemes or industry specific fund. Now, what is this? The collected amount is to be invested in one particular industry. That is nothing but industry specific schemes. Industry specific schemes invest only in the industry specified in the offer document. Is it clear? See, whatever they collect amount, they invest in one particular industry. Collected amount to be invested in one particular industry which is specified in the offer document in a prospectus they mention, right? Such type of fund is nothing but industry specific schemes or industry specific fund. The investment of these funds is limited to specific industries like chemical industry. For example, asset management company, what they do, they collected amount to be invested in only in chemical industry or one IT sector. Okay, that is nothing but industry specific schemes. Even one sectoral funds, one and the same. Sectoral fund, both are same, one particular sector. uh, okay, some authors they use these two are different types. Actually the meaning says both meaning same. Okay, next one, hope you're clear. Industry specific scheme, whatever they collect, whatever the asset management company collect the amount, that amount is to be invested in one particular industry. That is nothing but industry specific schemes. Index schemes, next one. What is index schemes? You know what is index, right? Here BSC, that is BSC index is nothing but Sensex, right? Sensex is the index, right? NSE index is Nifty, right? Nifty. Now the collected amount The asset management company, whatever they collect the amount, that is to be invested in, it may be in Sensex or Nifty. It means uh, the companies, those who are listed in Sensex or those who are listed in Nifty, on those sources or those companies, this asset management company is going to invest. That is nothing but index funds. In these schemes, the funds are collected by mutual funds are invested in shares forming the stock exchange index. Is it clear? Example, Nifty index scheme of UTI mutual fund. Another one, Sensex index scheme of Tata mutual fund. Is it clear? These are listed in, see, this Tata mutual fund is listed in Sensex. So the entire amount is going to invest in Tata mutual fund, right? Or else in different type of different companies. Take for example, SBI mutual fund. Okay, SBI mutual fund. Okay, now the asset management company collected amount is going to invest in SBI mutual fund. These are listed in index. These are listed in Sensex or else in Nifty. That is PSE index and NSE index. Is it clear? That is nothing but index schemes. Next, sectoral schemes. I already told there is specific industry and sectors index. Sector schemes both are same actually. Sector funds are those mutual funds which invest in a particular sector of the market. Take for example banking, information, IT sector, right? Whatever they collect the amount, they are going to invest in banking industries or they are going to invest in IT sector. Is it clear? That is one particular sector. They are going to invest the amount in one particular sector. That is nothing but sectoral schemes or sectoral funds. Next, last one, that is gilt-edged security or gilt security schemes. What is this? In some authors they use this spelling also, that is gilt. Okay, okay. Now gilt security schemes, gilt edged, you might have heard this, gilt edged security, gilt edged security. What is this gilt edged security? It is nothing but government security, remember. Okay, gilt funds are debt funds that invest in government security. What do you mean by this? The collected amount is to be invested in only in government securities. That is nothing but gilt security schemes or gilt edged funds. Hope you are clear. Collected amount is to be invested in only in government security, then it is gilt security schemes. Hope you understood all types of mutual funds. It's very easy to remember. Whatever they collect the amount, where you are going to invest depends upon that. These are the types are classified. Is it clear? If you invest whole amount, whatever they collect amount in, if you are going to the asset management company is going to invest in equity shares, then it is equity fund or growth fund. If the collected amount is to be invested in debentures or government security or bonds, then it is debt fund, right? Then um, then one, if collected amount is invested in one particular sector, then it is sectoral fund. Then collected amount is to be invested in index or it may be Sensex or Nifty, then it is index fund. Then industry is over. Then money market, collected amount to be invested in money market instrument, then it is money market fund. Balanced fund in the sense, collected amount is to be invested in equity plus debt. If the asset management company invests in equity fund as well as in debt, then it is nothing but balanced fund. Hope you are clear. Then last topic of this unit, that is regulation of mutual funds in India. Now who is the regulator? There are three. One is SEBI, another one RBI, and one more central government, as well as one more is there, that is EMFI, that is Association of Mutual Funds in India. Is it clear? Who is going to regulate? Who is going to regulate the mutual fund? Mainly, that is SEBI, Securities and Exchange Board of India. Mutual funds are regulated by SEBI. In 1996, SEBI formulated the mutual fund regulation in the year 1996. SEBI is additionally the FX regulator of capital market and its intermediaries. SEBI is the regulator of the capital market. Along with the SEBI, mutual funds are regulated by RBI, Companies Act, Stock Exchange, Indian Trust Act, Ministry of Finance. Is it clear? Along with the SEBI, mutual funds are regulated by RBI, Companies Act, Stock Exchange, Indian Trust Act, and Ministry of Finance. RBI act as a regulator of sponsors of bank-sponsored mutual funds, especially in the case of funds offering guaranteed returns. See, RBI is going to interfere, especially in case of funds offering guaranteed returns. Guaranteed return in the sense fixed rate of return. Those mutual funds which offers guaranteed fixed rate of return, at that time RBI will be the RBI will be the controller. Remember, in order to provide a guaranteed return scheme, a mutual fund needs to take approval from RBI. Remember, those who issue those companies issue mutual fund regarding guaranteed return scheme, then they are going to contact RBI. They need to get approval from RBI. Okay. The Ministry of Finance acts as a supervisor of RBI and SEBI and affiliate authority under SEBI regulation. The Ministry of Finance acts as a supervisor of RBI and SEBI. Then mutual funds can appeal to the Ministry of Finance on the SEBI rulings. Take for example, if one particular company, mutual fund company, is not ready to accept the SEBI rules, then they can appeal to the Ministry of Finance. Is it clear? Then, who regulates the mutual funds in India? One is SEBI, then second one RBI, then Ministry of Finance, then AMFI, that is Association of Mutual Funds in India, has been made to develop this mutual fund industry of India on professional and ethical lines and to enhance and maintain standards in all areas with a view to protect and promote the interest of mutual funds and their unit holders. The main duty of AMFI is to provide a professional standard or ethical standard to the mutual fund. Okay, to provide professional or ethical standard to the mutual fund. And also the main objective of establishing this mutual association of mutual funds in India is to promote and protect the interest of investors or unit holders. Okay, mutual fund holders or interest, protecting the or promoting or protecting the interest of mutual fund holders or mutual fund investors. Is it clear? SEBI, RBI, Ministry of Finance, then AMFI. These are the regulators of mutual funds in India. Hope you are clear. In case any doubts, you can contact me. Thank you.